Our next guest warns there is too much optimism heading into earnings season. Peter Boockvar is the Chief Investment Officer at Bleakley Financial Group. He's also a CNBC contributor. So you would posit, I would imagine, Peter, that we are still too high on a multiple basis on the broader markets, considering what we are about to get into earnings season.
Well, I think pendulums swing in the other direction. They don't just stop in the middle. And if you look at a multiple perspective on a PE ratio, where we topped out at, 22 times, and now we're about 17, 18 times. I just don't see that as being a trough valuation, particularly with rates where they are and the earnings trajectory that we're seeing, which is down. So I'm looking at a multiple that's going to bottom out at 13, 14 times. Now, we can all debate what earnings that will be priced off, but I don't think we're close to pricing in an inexpensive market, which usually typifies the end of a bear market.
Higher for longer, Peter. People are discounting it. It's in your notes. I agree. You've said it for a while. That's been the missing piece that I don't think the market is fully taking into consideration.
I agree. When you think about, call it a 15-year period where borrowing costs were very low, and then all of a sudden you get this vertical move in interest rates. Every month that progresses from here, there is somebody refinancing their debt at a much higher interest rate than that of the loan that is maturing. So each month, each quarter that progresses from here, cash flow is going to be more eaten up by interest expense. And we know that leverage and credit have been a main driver of economic activity and less so natural savings. So as this cost of capital just remains elevated, I mean, just by keeping the Fed funds rate even at current levels for a longer period of time, creates its own downdraft on the economy, again, because of all the debt that's out there, priced at a much lower rate than current market rates that will then be refinanced in current market rates.
You know, Peter, much has been made about what the companies are going to be saying in terms of guidance, but we have had some remarkable changes in just the past, month or two in terms of where rates have come, where the dollar is, where inflation expectations are now. Do you think that perhaps we're too on one side of the boat in terms of anticipating that the guidance will be so horrific this time around?
Well, it's a good question. Maybe, but I think the profit margin story is really the next focus here. If you look at two of the main drivers of profit margin expansion in the last 15 years, outside of the corporate income tax cut in 2017, was lowered interest expense and low wage costs. And that has clearly shifted to the opposite side. So I'm actually thinking that the U.S. economy, or I should say the global economy this year, may actually be okay relative to current expectations because of the reopening of China. But profit margins, on the other hand, could be a real depressant. I mean, profit margins 20 years ago averaged above and below around 6%. We're twice that. There is a lot of mean reversion in profit margins that could be enough to clip earnings, even if revenue growth doesn't really change that much, even though I do think for those domestically based companies, you'll see softer revenue growth than that internationally.
Peter, it's Karen. Thanks for coming on. So you talked about the pendulum of earnings swinging. It was too high in the low 20s. Where we are right now it doesn't stop here. Where do you think it would stop?
I still think 13, 14 times is where it's going to eventually end up. I mean, just look where interest rates are at 15-year highs. To me, that just augurs for a lower multiple. And I think we'll eventually get there. Again, the key part of that is what earnings you're going to price that off. But I think we're still, and that's just a P ratio. I mean, the price to sales ratio on the S&P 500 is pretty much the same where it was in March 2000. So we can use other valuation metrics that still equate to a very expensive market, notwithstanding the pullback from the highs.
Peter, always great to get your take. Peter Boockvar of Bleakley. Dan, which sectors do you think are most vulnerable?
Well, first things first on that multiple, it's interesting that, the 10-year average like 17 in the S&P or something. And so, I guess we kind of got, when we were really kind of gloomy maybe at other periods, when I was selling banks at the lows or something like that, we're like, where do we bottom out normally 13, 14 times? Yeah. And then you're kind of looking at what like a trough earnings should be or whatever. And that's just not going to happen. Guy, you made that point a couple times over the last few weeks or so. So let's just take the average for, Let's just take 16 or 17 times. And I guess the point that S&P earnings are still expected to be, north of $220. We've had this conversation a lot. It won't take a whole heck of a lot of just a kind of economic malaise. I don't even mean like the hard landing scenarios of just, some sort of recession that we're not going to know until we're on the other side of it to get earnings closer to $200 times 17. It gets you down 500 or 600 points on the S&P 500 from here, below those October lows. So I know we're going to be obsessed with those October lows for a long time. I just think it's important to recognize the fact that, it seems like everybody's convinced that the first half of this year, there's going to find a bottom in the stock market. That makes me a little bit nervous because that consensus is here. And we're not going to know, what the multiple on what the earnings are and where they trough until way after the fact.